And then I said, sign me up for that. Sign me up, baby. Sign me up.
Everybody, what's up? Sorry for the delay. We are back. What's up? Good morning, good morning, good morning. All right, you guys should be getting, you guys should be seeing your stuff right now. Mine's starting to trickle in. Things are looking pretty okay here. Okay, good, good, good. All right. Yep. Dude, some kind of small error. This is our bad on this. We left I wrote the explanation in chat what happened. We wrote remember we switched data feeds a month ago, give or take. Right? A couple of months ago. We left the old data feeds around so that people could have some time to switch. Maybe he has a huge grace period to switch over. So when we switched everything, there were still some old API keys from the old data feed and some of the config files that caused a bug. Backend stuff. So today they severed the old data feed. So today people that are still writing on the old data feed, it's gone. So what happened was it was just not connecting to a little buggy bug. One time bug, the data switch. So we had that fixed. So sorry about the outage, you guys. Looks like we're sitting here pretty nicely on BLUs across the board. Looks like we missed this one. Things looking pretty tidy. D band's 5163. Resilience is bullish. Looks like barely bullish on the S&P. So resilience is pointing upward here. QQQ resilience is pointing down. BLU is pointing up. BLU is pointing up. News in about 2 minutes. Yeah, let's check that out. Let me get a little hedge pressure tap on the news. That'd be kind of good. Thank you guys for all your patience. We love y'all. One-time bug. All this Fed stuff. Let's look at the monthly maps. Yeah, that's one thing. I have to pull in like a... Let me double check that. No data, yeah. Everything should be reset by tomorrow though. These little things. I didn't notice the monthly maps. Thanks for reporting that. Okay, still checking things. We need to pull the data again. Dude, they're so good, Grant. Yeah, for stocks, that's one of that's where you see a lot of the strongest you know, sentiment. As long as no news comes out on that particular stock, those monthly maps are solid for swing trades for like a month out. The news, oh, the Dallas Fed meeting business index, probably not going to be a large market moving catalyst. So should just be. And nothing on monthly maps yet. Or we pull the data. We ran another manual pull for the monthly maps to get that data come through. We'll see if it wraps up in just a second. On the tech stocks are very transparent options. They're so liquid and so popular. You're just gonna see so much activity off of that. Okay, let's see the monthly maps come through. Again, sorry for the data outage, you guys. It happens outside of our little morning checks that we do. How that particular thing wasn't observed until market open. It's likely when market open is when the tie was severed, or maybe an hour or two before, because we're starting to get reports that something was going on. But we've been on it for a couple hours looking at it, trying to figure out what's going on. Normally stuff like this, if they would like do it on a Friday, we would catch it. But the one thing with stock market and platform is that like data feeds, you know, they're not running on the weekends. So it's like we can't check until things go on. So like we do these diagnostic checks at 4 in the morning, and our pre-market starts, and this was not noticed. We usually do another pre-market check right when markets are about to open, 30 minutes before. We were already on this one. We just didn't know what's going on. And we figured it out. No, this is not a platform thing. This is just a data feed thing left over from us switching data providers. We overlooked that one little thing in our code. Just config files. looks like the market's somewhat stable, and ooh, there's a little graphical. What's going on there? We just have to go with that monthly maps today. Okay, so it's like S&P resilience is hugging close to 0. Nasdaq resilience is less than 0. So Nasdaq is trying to find its way lower, and the S&P is trying to find its way top of the box. Today's trade, we're actually supporting on 51.39, which is a yellow line S&P right here. This is a nice. We had a little bit of a gap up here, which is neat to see. That did not fill. It's very bullish, I would say, in general, to see that in futures. To support on yellow line, also bullish. So I think the index being driven today by the S&P stocks, the indices, rather than the Nasdaq stocks that are kind of looking a little less aggressive. Keep your eye out on this one. The S&P bull zone support, always a thing when DD ratio is greater than half. I always hit the bull zone bet. Wish I would have got this one today. Missed it. But things are looking solid. So it looks like today we're not going to get a big nasty sell-off. There's no catalyst. There's no news. Anyway, earnings reports coming out. This is big earnings week, right? So I think most of the movement after hours, this is looking like some pre-earnings short covering. I think that the tech stocks with Amazon tomorrow, I think couple of tomorrow's a big well-rounded day because there's like Mondelez, I know it's tomorrow, and I think McDonald's also tomorrow. A couple other big ones. Yeah, these big earnings weeks typically have like a lot of movement. I think Apple and Amazon are this week also. Yep, they certainly are. I think Wednesday, or no, maybe Thursday, I think is Amazon and Apple. Let me double check. Let me open this up. No, Amazon is Tuesday. Apple is Thursday. Okay, Apple is Thursday, yeah. So Apple's aftermarket on Thursday, Amazon is aftermarket. So your tech stocks are usually going to be aftermarket. PayPal's tomorrow before market. Yes, I think PayPal's tomorrow. Let me look. That's correct. Yeah, tomorrow morning, PayPal in the morning, Starbucks afternoon. Oh yeah, Coca-Cola tomorrow. Yep, AMD tomorrow, McDonald's tomorrow, Amazon tomorrow. So here's that negative resilience that we're seeing right here, starting to try to pull the stocks back. So anybody that's swinging this or looking for just general support, there's really no mechanism today to tank the market. So if it does break hedge pressure and keep trading lower, you know that's a sign to get out of the way. There's no volatility today. UVXY and his liquidity map is downward, and VIX futures is showing stability. So what happens is, when it shows things are stable, and if you sell, you trust that sell, that you're on the wrong side pretty easily. It's not volatility that would cause you to break bull zone. It's not anything else. So a neat thing about risk management is knowing that if the unexpected happens, which would be like, say, this thing right here. Let music go. I lose my music. If this happens, which shouldn't happen at all, that it would be genuine overpowering selling, because there's no event, no catalyst, there's no volatility, there's no reason for the bad to happen. So if the bad happens, you don't play with it. So example is, if I'm trying to buy at 509, it starts trading lower, I don't say, you know what, maybe it'll snap back up, without any other clues or any other events to cause it to happen. You know that somebody's just bombarding it with selling. So what's going on with my YouTube here? Okay. Okay, you guys can still hear me here. What is up with this? Yeah, so to tell you, Tony, Tom, great question. So resilience is not necessarily indicating in general. I think you're asking because of the complexity of the two indicators together. So as resilience only looks for the desire for the S&P to move through the redistribution zone like this, the fact that you will have negative resilience could hint as a hint of a possible move like this, right? As we're trading above here, it hints at a possible hedge pressure break and likely bull zone break, right? So the idea is, the answer is yes. Resilience right now is showing that it's possible to have that unusual move. And if that unusual move happens, we don't usually take that bet that it recovers. That's why, yeah, correct. So inside of here, yeah, that's one of those battling things. So that like the futures have gapped up, stocks have gapped up, and now the stocks are starting to trade lower through here. So there's a video actually called Resilience Can Forecast a Hedge Pressure Break. And it happens very often when you're in this situation, when you have your blue or yellow line is inside of the white box. And that's pretty common analysis to make. It's a cautionary. So inside of here, like at the start of the day, like we didn't have the number to look at, but while we're trading up here, it's lacking the desired momentum to keep rallying higher. So I wouldn't, looks like from here, yeah, I'd be a little nervous on this one. let's double check the see if the monthlies have rolled through yet. Yeah, there we go. Monthly maps are in. Perfect. Okay, let's take a look. It's still bullish, set up on Qs at least. So another thing I was going to say is that when you have those competing signals, you know, which one is stronger? That's always something we want to look at. And let me pull up our little priority sheet here. On the priority side, so anything that has to do with zones or liquidity map is right at the bottom. Redistribution zone half gap is slightly higher priority. Resilience, the white one is more of a priority than the yellow one when they're both interacting. Yellow lines, illiquidity pivots are higher priority, and then DD ratio, DD band stuff is the highest. So anything related to DD ratio, bull zone support or bear zone resistance outranks everything else. It's the most probable thing that we have in our indicators. So while resilience may be pointing down, DD ratio is pointing up, we bet the DD ratio wins. And when monthly maps are starting to show kind of a bullish spread, and this is still bullish, this is still bear squeeze, then there's really no bigger kind of scare on the market right now. It says we're going to lose bull zones. So you see resilience as aha, it's going to give me that low I want. So as it moves through here, the bet I always take is that we hold bull zone. Yeah, it's funny, Alexander, because this is like Pokemon lo-fi music. It's actually like a lo-fi mix of games, but a lot of it's been Pokemon. I noticed that too. Chairs, yeah, let's take a look. So let you guys know, this is the first. I'm going on my first week of my health scare being over for love. Like this has been a horrible year plus of my life dealing with trying to fight my stage 4 hypertensive crisis that I basically lived with every day for like a year plus. So I'm back. I'm living. I'll tell you all my regimen. That's showing working. Community traders, little bull selling, bear squeezing, creating that support right here at 5,000. So they're gonna like this, right? What happens is that as the market is just going higher and higher and higher, people are just selling before earnings. That's it. People just taking a little bit of profit. The idea that the minute that the market dips at 5,000 and then you see all the covering happen is because the bears have been upside down for so long they can't wait to get out. When markets dip and you don't see a lot of covering, that's how you read the COT. When you get a dip right here and you don't see a lot of covering, it means that people are holding on. They believe in the bear case. When you see a dip and there's a lot of covering, it means the bears were wrong and they held and held and held and held, and they finally got their way to get out, and they got out of the way. So, dip and cover, a little bit of covering, just a little bit, but there's still a lot. So bears got out of the way, and as you can see, it didn't crash out. But this one, there is like just a little tiny bit of covering right up here when it dipped. but then nobody's covering as it's falling. And it fell for 3 more months and nobody was covering. And then people started shorting, betting that the market was going to get worse, and the Fed, started saying stuff that's going to make things better. So in this particular case, you see that the bears were so scared they got away as fast as they could, which is a little bit of bull selling before earnings. Dealers are so negative right now because the net sum of buyers, there's a lot of people long and just a little bit of profit taking. There's a lot of people short and then everybody covered. So there's a lot of longs and a lot of buying from the covering, which means the dealers are going even more negative. It's very, very solid, very bullish. And the fact that they're pinching together now while they were throttling or they're pulling apart there, anytime they're pinching or pulling, it's liquid, and it's liquid enough to prevent market crashing. When markets are liquid, volatility collapses, and that's what we've seen right now. Let's see how that works. Love, love, love this kind of analysis. So it's just telling you that the market's monthly maps are telling you. So let's go through the pieces. Monthly maps, bullish. DD band, while it was scary for a little bit, DD ratio, bullish. MHP, right? We're trading above MHP on S&P, bullish. The 3 signs in our video that says the greater bull market is back. Market is liquid enough, the volatility is crashing. Check. So we're liquid going into earnings, which is great. You're not going to have big volatile swings, which means if you have like on like the liquidity map, if you do start breaking bull zone, it's not volatile enough to believe that it would bounce back up and go, because those big V's come from volatility. When markets are liquid and you break through pivots, you trust them that it's genuine selling. The best part about liquid markets is it's easier to trust your signals and trust your signal breaks. Right? Volatile markets have overshooting pivots that make it harder to believe that this is going to crash out. Volatile markets. The opposite is liquid markets. Liquid markets, if you start breaking hedge pressure or hugging hedge pressure and holding there, instead of just quickly bouncing, you believe that it's going to be lost. Liquid markets tend to have sharp pivots and they act pretty quickly. We all understand that. It's all in the teaching. So this is a sign that there's no volatility anymore. For a little tiny bit, there's a little bit of selling, but shorts are covering at the same time. So whatever volatility we had is very short-lived. So commitment of traders is just, it's weak old data, but it is supporting the idea that things are slightly okay now. Again, I don't even see my candles with the way resilience is starting to deteriorate. It's something that the market might get a little bit of pre-selling pressure right now, at least try to attempt to make a move down. So it's trying to get there. Yeah, does this all make sense? Okay, cool. So the greater bull market is here going into earnings. So what I like to do is I like to find nice solid supports, easy R&R to determine where I wanted to long. Now today, if my data would have been up, this would have been the great long to get in, to swing, to stop one strike below. How easy would it have been, especially for like trading through earnings? Let me go ahead and like sell a put spread or something like that, right? I can buy puts here, like maybe for Friday expiration. Cheap puts, you can sell puts there, or I could go the other way around. I can buy the puts as long as we break through here. The delta kicks in faster and sell puts out there. Sell enough of these to turn that into a credit, like sell 3 for every 1 or something like that. So betting that the market doesn't just collapse out and gain IV, so your sold puts go to trash if IV gains because the market's not volatile. So betting on low volatility, high liquidity, which means premiums will be lower. Now again, going into earnings, a lot of times your specific stock premiums will be higher because the IV goes up. So when IV goes up, you always want to be on the sell side. So in particular cases like this trading the earnings, those sell legs are very profitable if you're even selling options to hedge against something you're in, or to be part of a spread. So a lot of traders will do is they will engage in a credit spread here. So when you're on the sell side, you're betting that it doesn't go somewhere. So with this being strong and all the greater bull market, again, this is not investment advice, just my personal opinion on trading styles. If all the greater market signs are pointing up and the data looks good, and while resilience is pointing down, it just tells me, aha, I might get some lower lows for my leg on the sell side. So just in case if I was long the market, want to buy puts or whatever, or I just wanted to buy puts in general, I would buy them down here. Because if we hit bear zone, certainly I want to be hedged to the short side or selling. To bet that we don't break bull zone because DD is strong enough, and I can, the don't break bet is selling a put underneath it. So on the sell side, theta decay is the fastest at the money. So selling the literally selling the 5 of 9s would be a great trade. If it was 0 day. When it's a week out, it doesn't matter being exactly at the money. But ideally, it's like if you know like 0 day options, a lot of people do this. They will literally sell the bull zone put, betting that the bull zone doesn't hold. Because remember, under all cases of rational, irrational, 75% of the time, excluding irrational, this is our latest back test. Remember, it's the 80s% when you're looking at just rational. But if it's just all irrational or rational, doesn't matter. Our back test revealed that. But the still probability is overwhelming that you stay in bull zone. 75% of the time on SPY. 25% here. That's the split under all conditions. This number goes slightly higher when all these numbers are green. So what most traders do, and Ashton used to teach this, is that when you're in a bull zone, you're selling puts outside of the bull zone to bet that it doesn't leave the bull zone. And if it's 0 day, selling right at the money is great, because if you're just hugging this, that theta just plummets like a rock, especially leading up into earnings. You have high IV, you're just your profit just sinks while it's hugging this level. As you get closer to that expiration, it just plunges right up. And just to cover your ass in case the market collapses, buy some puts because you're leading to earnings, and do a diagonal spread. Example. So you're going to give yourself some longer time on the puts you buy to hedge against the puts you sold. So in the diagonal spread, you're doing calendar and price. Vertical spread plus a calendar spread is a diagonal spread. So like an example was if you were to sell, if today was like earnings today, right? And you're like, I'm long, say that I longed some kind of thing. Say that I'm long Apple stock going into earnings, okay, in my portfolio. And I want to do a little trading against that just to hedge. I got some money. I want to get in some options trades just to hedge. Okay, so my long Apple is going to need some puts to protect it, right? So like literally, let's pretend that Apple earnings is today. So right now, Apple is certainly bullish. Market's good. We're trading higher. Resilience is down. Liquidity maps are up. Bull zone is up. So I just need to get some puts on Apple. Literally right now, I would buy my puts for Apple for like Friday. Now they're going to be expensive because the IV is very high in earnings day. So you shouldn't buy them today. But if you forgot to, you'd still need to get them, right? So let's get them for at least a week out. This is just an example. You're like, but man, I paid so much on that premium. That's going to bite me in the ass because I bought them the last day, which is options rule number 1. Never buy options leading up into earnings. Never buy options. But you kind of needed to. So what do? We get on the sell side as well. And you can do this trade anytime that's not earnings, just in general. But you're saying you're long the stock, you want to buy puts to hedge. It's going to be very expensive insurance because you're buying them the last day. So why don't you get in the insurance selling business and get on the other side and then make that premium back by selling? If you do your spread this way, you're selling the closer to the money option. They're going to be more expensive. So you can establish somewhat of a credit by splitting them this way. If you back these out into Friday, they're going to be even more expensive because it's further out in time. You make up that calendar distance by selling near term, like 0 day today puts to bet that Apple earnings don't collapse you today. If they do, that volatility goes way up. Now the IV will collapse on both of these options, but your spread should at least give you an exit here. In the case it does collapse, you have an exit here and it just costs you a little bit of money. This is a credit, so this didn't lose you much, except for the IV crash for the most part. So you can actually hedge your Apple, or you can just buy the option straight up. It's very expensive insurance. The sell side will give you the added bonus of if that IV collapses, the sell side puts that IV in your pocket. And if the bull zone does hold, then you've made your credit as an additional trade to the long side. with hedging your long shares in case it collapses with an exit target here. So like people do trades like this, a little complex. This would be like, you know, 1 to 2 days out. So you could probably, you could sell like the nearest term, and that near term will make money as long as it doesn't crash. And if it does crash, well, then you have some longer term options that you sold those to pay for these, and they're longer term out. So while that IV collapses, they still gain in premium because of the delta if you keep falling. So these like kind of, what do they call them? These diagonal spreads. Ways that people use them to fight off the way IV changes closer to earnings and after and before earnings. So if you're confident in the long side of the trade, you clearly would be on the, even if it wasn't around earnings in general, you could sell puts that it doesn't break and then buy puts down here if you're actually long to hedge. Or people that are just day trading options. I know it's not advised in general by people that tell you to try to trade like to sell options naked, but people do. That's how these 0-day day traders that love to do the sell side will sell down here, because 75% of the time they close worthless, selling puts below bull zone. And conversely down here, if you're in bear zone, DD ratio is less than half, people will sell calls all day long against it. Let me check for you, Tom, real quick. Hold on. So, I don't see where my 14.4. Yeah. You did the trade on the HP overnights. Very nice, very nice. And we're still trying to find a way to put the overnight pivots into the liquidity map strategy, because we've been finding lately that the overnight pivots themselves are still actionable in the daytime, which is a new revelation that our members have noticed over the years of trading. These overnights we just utilize until 9:30 in the morning, but we're starting to realize that throughout the day they still are actionable for whatever reason. It's somewhat misunderstood why that happens, but they're still buying and selling at them in the daytime, which just means that the residual position that's creating that effect and that hedging at those two boundaries overnight still isn't fully liquidated until sometime during the session. So for an example, if there's a monthly hedge pressure overnight calculation here, we'll notice it'll still bounce throughout the day there as well. It'll try to. So whoever's longing from there because of the situation overnight, which means they're hedging in that darkness of not knowing what the options look like, that whatever position they get into on both sides, whether it's options, market maker getting the options before the market closes or not, whatever position is set there and anchored there is still acted upon even in the daytime session. So that's likely what happens. Markets are closing. They're going to buy options in both places and start hedging them with futures at those boundaries. Those options positions are probably just held to expiration, and then they just trade it all day until that option expires. So likely it could be actionable till the option expires, and it could be 0-day options that they're using just to hedge those overnight positions. So, or selling options at those boundaries. Because if they know, like if I'm a market maker, here, let me show you. Here's an example. I'm a market maker and I know the landscape of the market, and therefore I know where I'm buying, where I'm going to be buying, and I know where I'm going to be selling, because I know where my firm is going to be longing and my firm is going to be shorting. Therefore, if I know we're going to be throwing all of our money here and all of our money there, then I know I can get into the option selling business, and I can sell calls all day long up here and sell puts all day long down there as a market maker, because I'm longing the market and shorting the market against it. So if I'm pushing the market up there, I'm going to bet that I can overwhelm the market and supply liquidity, and I'm going to sell insurance to anybody who wants to buy it outside of where I'm buying. So that behavior is what we believe causes a lot of this activity, as a lot of these options are sold right at the end of the day as people are buying and selling options to hedge these ranges. If I know where I'm going to be hedging overnight as a dealer and using futures to do so, which we calculate where that hedging is likely to be based on where those options are, that overnight dynamic tries to guess at what the end of the options landscape looks like. Therefore, if they just if they just sold, like a lot of these were like 0-day options that they sold, then throughout the rest of the next day, they're just longing the market against that area and shorting the market against that area to push it out of the way for those options to go bust, which is why we likely see those things to be actionable throughout the day, because they're hedging against options. It would make no sense for them to be actionable throughout the day unless there's some kind of hedge, because that position is calculated based on options. So therefore, it means the options still exist. So whatever options were there were likely bought or sold, just in this case sold previous day. Then it makes sense because options are going to expire the following day. Nobody's going to buy a 0-day option the last 5 minutes of the day that expires that day. They're going to buy it at least 1 day out. Therefore, it makes sense that the overnight dynamics still pivot at least 1 day out. Does that make sense? So that's kind of the going theory, even though it's not fully understood. That's my belief as to what's actually going on, because I know the calculation is based on options, trying to examine and estimate what the options will look like the next morning. And so overnight, that's hedging against the options landscape overnight. Therefore, the options from yesterday are expiring at least today or later. So therefore, the actionability will still be there today. And then that does make sense. That's really what's going on. So it means the dynamics are still part of the equation in the daytime. It could be another pivot, another irrational roll, right? Another bull marker if the overnight positions. Yeah, unless you're the kid that made 100K off of $800 the NVIDIA. Oh yeah, the buying, was it NVIDIA puts person bought? I read that one. That's great. Man, I'm tired. So looking at the setup right now, I'm going to bet that we're still probably good. I think that we're still probably good, at least from here. If I were to make any kind of trades, it'd be a small long there and medium long there. I would stop underneath here. With resilience being like it is, I would trade very small on both of those. I would be throwing micros at it. This is cautioning me against making any trades, to be honest, right now in the Robbins Cup. The idea that it's likely to want to try to break here. Now it's not. Again, we don't know the probability. We haven't done a back test of this scenario. Chances are it likely holds bull zone. If it hadn't touched bull zone yet, I would be willing to make the trade. But the fact that I missed that trade, this is exactly the trade I'd want to be making. The fact that we hold bull zone and go. So in trades like this, where you have a competing signal where this is there and that is there and that is there with no volatility, it's kind of like a toss-up. So it's kind of hard to say while this number one outranks number two, probability is greater that one happens. I normally would take the one trade if it hadn't already happened. Every time I'd be waiting for hedge to break very quickly, and then I'd at least long back to hedge pressure at minimum. The fact that that already took place, which is the trade I look for, is gone. So I always long bull zone bottoms on that first tap. If it happens again, I'm not going to take it. Do we understand? Typically, if you lose hedge pressure in a non-volatile environment, and you start losing it again, that's rare. That's rare. Without the volatility, it shouldn't be breaking. This usually volatility can cause overshooting. This is no longer an overshoot. A second time is a break. Louis knows that. He's been here for a while. So volatile markets can bounce around a lot before it takes off. Non-volatile market, which is today, you trust your signals, right? They usually move pretty fast. See how it's not hugging. It kind of broke a little teeny bit as it's trying to sell because of the resilience. It wants to go here. Just the overwhelming strength of that pivot being the highest priority in the big three is what keeps it going. If we start breaking this a second time, it's bad news. We don't start breaking it a second time and then start rallying with VIX collapsing. If volatility was higher, then I'd trust a second break and a third break more. I would trust my pivots more, because this is just volatility in a thin market, lack of traders. Lack of traders means volatility goes up. But in a stable, solid, non-volatile market, a second break is to likely be trusted, and it's likely to complete that move. So what I don't do is I don't short. I don't bet against the bull market with all the greater bull signs. I still take the long side, but I take the long side very small, because I'm in the challenge account. I don't risk it when signs are all weird. I'm just taking my setup that I know that works, which is unfortunately trade. I missed that today. But we are good from here. So if I were to long, I would long micros exactly right here. I would long a couple more right here. And just bet that the market doesn't break bull zone, because that's really strong. And then I would be watching for resilience to recover itself. But it's likely, but what you're seeing is that there's like this kind of split effect here. Right. Market wants to be bullish. Some of the stocks, the majority of the stocks don't. So because of that, I'm sitting out in general. I can either play a couple micros to the long side or probably sit out. Initially, I would have done this trade right here and here, and that's the trade I would have taken. At least to fill the box. If res is negative, when you touch the top of the box or you trade up here, you know to get out of the way because it's going to come back in. So any negative resilience pulls back to that side of the box or tries to. So my trade would be short-lived. I usually trade to fill the gap or to touch one side of the box, and that's it when I have competing signals. If resilience wasn't competing, I would trade it all the way up to DD band, the full spread. So he said somebody were to put a gun to my head and said, pick a trade. This is the trade I would pick like right now if I were to trade, but I'm not. Longy here, longy here. And that's it. This is very Pokemon-y. I've actually been picking like random music. Let me find it. Let me find another one too. Let's see. 10 hours of lo-fi video game beats. Let's go. Big decay continues. Yeah. So the coolest thing about any kind of trading is that when volatility is in decline and your signals break, like whatever signals you not even hear, any indicator you use, that the price is going against your indicator signals while volatility is decaying, you trust that break and you get out of the way. If your signal was like when these two things cross over and this other thing crosses over and this other thing is, oversold and we're down here and cool, I'm going to long the market. And, it goes up, your signals work and work and work. Then all of a sudden price breaks your entry point, despite all your signals being long and volatility is in decay. You get out of the way quick, because just to repeat what I keep saying on volatility, volatility is a condition of the lack of buying and selling at the current price. So if there are a lot of people wanting to buy right here and a lot of people wanting to sell right there, it's very liquid. Liquid is the inverse. Liquidity is inverse of volatility. The more volatile the market is, typically it comes from less liquidity. The less volatile comes from more liquidity. Liquidity is the rate at which buyers and sellers find each other at the current price. So it's the amount of transactions that take place per second, or the willingness of people to buy and sell at the current price, which means like your spreads are really small and you have a lot of buyers waiting here and a lot of sellers selling there. If buyers and sellers are like parked further away from the mean price, then the market's less liquid. Or if they're scattered in time, like if you buy a house and it doubles in value and you try to flip it and it takes 10 years for it to sell, it's less liquid than if it sells tomorrow. So at the same price. So if people are willing to buy something very quickly and at the current price, that's liquid. So time and price are both functions of volatility and liquidity. So when markets are liquid, then things should be trusted more. Your indicators should be smoother because you have a lot more buyers or sellers here. If the market moves on a crossover, then it's being overwhelmed by the presence of buyers. You have like more data points. Remember, just from science and math class, like the more points you have, the stronger the trend is. More data points. So indicators are to be trusted. The more data points you have, the more buyers and sellers you have, your indicators should be trusted. Pivots should work sharper. They should be more defined. And if price turns around and slams the other way, despite all your indicators looking great, when there is no volatility, then you trust that the market sentiment has immediately shifted to overwhelm what the status quo is. So if the status quo, I'm going to draw these horizontal lines as being bullish, and there's a bunch of bears right here. There's more bulls than bears. Then, and your indicators cross to the bull side, and then the market starts to go up. If all of a sudden it starts slamming through despite all your indicators looking great and there being no volatility, that's the kicker, no volatility, then what it means is the bears have entered the picture in abundance to overwhelm the bulls. And because of that, you trust that. The market is liquid enough, meaning there's a lot of bulls and a lot of bears. So that there's already a lot and there's a lot more, it's going to overwhelm the entire market. So the difference is when markets are volatile, you can't really trust the behavior because there's not a lot of bulls and bears. The example of this, right? It's like if you say, man, if I had, 1,000 people at my party and 1,000 more people come, that's 100% gain. That's literally 100% gain. But if one person at my party and another person came, that's also 100% gain. But there's only 2 people at the party. This is 2,000. If I had 5 people come when one started out, it's a 500% gain. And I could say like on social, I had 500% people came to my party, but there's still only 5 people. Doubling the size here, 100% gain, is a whole lot of people. The more people there are, the more you can assume the price is agreed upon. If 100% of people in a smaller set do something, you can't trust that that represents the entire population, because you don't know what the entire population wants to do. Was your party awesome? Yeah, like it had 500% people came in like the first 10 minutes. Yeah, but you didn't really have a lot of people there. Still don't know it's awesome. Now, if you had 1,000 people and then 5,000 people came, you would trust that 500% gain a lot more the more data points you had. Obviously, it's a cooler party. Yeah, you've only 5 people. So this is the example like with trading. It's like the higher the volatility, it's the smaller party. So you don't, if markets are moving really fast while volatility is high, you don't trust that that move has anything to do with just there being not that many people resisting there in general, relative to the amount of people buying. And if 5 people are buying and 3 people are selling, then clearly it's going to go up. But you can't trust that the entirety of Wall Street has changed its mind. The less volatile something is, the more liquid it is. You trust that the entirety of Wall Street is on board with what you're seeing. Does this make sense? So volatility, to be useful as a trust indicator, is where it becomes very useful to you. if you shouldn't break something and you're breaking it, the first thing you do is check on volatility. If volatility is high or bullish in a bull map, you say, okay, you know what? It probably is overshooting, and I'm just going to set my stop and set it and forget it, and then maybe it'll recover. If volatility is lowering or in a bear decline like it is now, and you start breaking your pivots, it's not going to bounce around a lot. There's a lot of buyers here that are getting overwhelmed, and you're going to know quickly to get out of the way. It's very likely going to break. So second challenges on hedge pressure. If volatility is high, that's more probable. If volatility is low, that's an early warning sign that the market's likely getting overwhelmed. So hedge pressure breaks are more trustworthy when volatility is low. All your signals are more trustworthy because you have more people behaving, and therefore it's showing a greater sentiment. It's going to take, like, buyers just entering the picture, sellers entering the picture can flip-flop the market around if nobody's trading. But if market's moving in waves of large amounts of people, it's very rare that bigger amounts of people are going to step into the already large party, because most people are already there. Okay, cool. So, is this Sonic the Hedgehog? No way. I like this playlist. We got some Sonic Zone Zero going on here. You know, Nintendo Switch, my girlfriend found this weekend. There's this thing that you can get for like $50 a year that plays all the classic games, Genesis, Nintendo 64, Super Nintendo, on Switch. It's like 1,000 games, something like that, for $4 or $5 a month. Just playing Donkey Kong Country last night, Paper Mario, Echo the Dolphin, just chilling on her Switch. That's cool if you guys have kids and you want to get them into your loves from when you were a child. Your classic games you grew up with. It's some kind of like, it's like the Nintendo yearly. So this is looking like it's probably, and what would be the cause of this losing? Hedge pressure losing, right? It's like right here, just quickly. It would just be because it's pre earnings selling. Clearly tech is some of the big movers. I like to look to see, you know, if some of the Amazon and Apples and such are being sold pre-market, like breaking monthly hedge pressure on Amazon. Forgot about Echo. I know, right? All the old school Genesis games, and I gave her a list. I'm like, all right, this is what you need to play. You need to play Super Mario RPG. You need to play Zelda: Link to the Past. You need to play Super Metroid. Gave her a list of good ones, and I was like, you gotta play these. Chrono Trigger, if you can find it, if they have SNES games. Yeah, Fed and FP this week as well. Yep. All right, I'll be right back. I'm gonna go get me some breakfast. I'll be right back. All right, we're back. Yeah, so it looks like the resilience destiny is starting to take off. So be cautious today. There is a yellow line right here at 51.39, exactly here, exactly here. So just keep in mind. Let me actually draw that. Let's make sure we have that here. This is an illiquidity pivot. It still ranks pretty high on the list. It's above resilience. It's above redistribution zones, above liquidity map, all that. So this right here is a pivot as well. So Looks like Resilience Destiny's taking over. This is a good reason. Good that I sat out on this. So let it fall, let it do its thing. I'll try to make too much of it. If it does anything, I'm just gonna watch it, let it do its thing. All right, y'all, I'm gonna get out of here. Things will be better tomorrow. Hopefully in the market will look good. No trades for me today. Should be back in live running tomorrow. Then you guys know AMP futures are live in Rocket Scooter. You can now connect to AMP futures as a broker inside of our platform as well now. So we got AMP added. I'm actually meeting with them today. Have a chat with them. So big things coming down the pipeline with us in the marketplace. Exciting. All right, so we'll see y'all tomorrow. Good luck today. And looks like today market's just not liking this pre-earnings stock sell-off, and resilience was definitely the key to avoiding caution. Maybe a good sign that we didn't have our data until later. All right, see you later.